Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
You've been on this book reading binge, Eric, ever since you published your book, and we have an author here today. Who'd you bring us?
Yeah, when I publish my book, there's always a couple books like below that says people who bought this like this one, you know that thing, and this one's always there, and it's somebody I know from Ritholtz, and it's Nick Maggiulli, and his book is called Just Keep Buying, which is somehow, I feel, linked to the book I wrote, which was, there's no way Jack Bogle would disagree with this premise. And what I liked about it is it's very practical. It's a really good book. It explains why you want to invest, how to invest, and it splits between savings and investing. And savings actually is important as well. It's half the battle. And it's really laid out very well. I like some of the anecdotes. And I also think my theory is that we're in an investor enlightenment era. And the first phase was just to get the friction out of the way, low costs, index funds. The second phase of this era is behavior. And there's a lot of behavior in here. Once you understand why you're investing, how it works, what to use, it's very easy to behave. If you don't know any of that, your emotions get the best of you. So I think that's a big part of this book as well. And but this year is a crazy year for the market. So I think it's an interesting title, Just Keep Buying, for this year. Maybe it's even more important title this year. So, I thought it would be cool to dig into this and get kind of practical.
So joining us on Trillions this time, we've got Nick Maggiulli, who's the Chief Operating Officer and Data Scientist at Ritholtz Wealth Management. This time on Trillions, just keep buying. Nick, welcome to Trillions.
Thanks, guys, for having me on.
Okay, so 3-word title. I've said it a few times already. Just keep buying. What else do I need to know? Because that's what I'm doing, man. I just keep buying. What could you possibly fill in a book other than those 3 words?
I'm saying if I can only give you 3 words, those are the 3 words I can give you, right? Those are the 3 words I would give you. But to expand on that, it's the continual purchase of a diverse set of income producing assets. If I could give you a sentence, but then even beyond that, the book's not just about dollar cost averaging. Obviously, some people are just like, oh, that's obviously it. I'm not going to read it. Like, no, there's a lot more to it. There's a lot of pieces of savings, about personal finance, things like how do I save for a house? Am I saving enough for retirement? How much should I save for retirement? Why should I invest? What should I think about market volatility, et cetera? All those types of things.
Okay, so I said your job title, Chief Operating Officer and Data Scientist. Mm-hmm. What did Barry, who's a frequent guest on the podcast from time, what did Barry say when you were like, hey, I'm going to write this book?
I kind of just told him after I was already writing it, actually. Like, it's not like I had to get approval. I was like, hey, I'm writing this book. Yeah. I was like, I'm writing a book, Barry. He's like, okay, great. Yeah. He's like, you put out enough stuff now. I think you can probably come up with something. I was like, okay, cool. Thanks. Appreciate that, Barry. So yeah, and I did basically. But no, he's always been supportive. I mean, I love Barry. I'm obviously, not just because he's like one of my bosses, but because, Barry's just a great guy to be around. And, I believe in the vision that we're building there. So yeah.
Just how'd you get the title? There's a little anecdote in here, and I love that you were able to find this title through something you saw. Can you go through that story, how the title came to you?
Yeah, so there's this, so Casey Neistat is like a YouTuber, you guys may have heard of him. He used to, I don't know if he YouTubes as much now as he used to, but he used to do like a daily vlog, and he was in New York City, and he had a video called 3 words to get to 3 million subs, right? And there's another YouTuber named Roman Atwood, and he gave him this advice. He said, if you want to get to, want to really grow your audience, I'm just going to give you three words of advice. Just keep uploading. And so that was his mantra. Every day I need to upload a video. Every day I need to upload a video. He kept doing it. And Casey Neistat now is like one of the biggest YouTubers ever. And actually, I use that. I remember hearing that right around the same time. I was doing some analysis on the U.S. stock market, and I realized, wait, just keep uploading, just keep buying. It kind of fits. It's a catchier way of saying dollar cost averaging. Because when you say dollar cost averaging, people's eyes glaze over. I think this is a catchier way, and actually is a more aggressive investment allocation approach. And really, that intro chapter kind of came from a blog post I wrote literally, 5 years to the day before the book came out. It was just by chance that happened. The book's supposed to come out earlier, but due to supply chain stuff, we had to push it a couple, 2 months.
The great paper shortage.
Yeah, the great paper shortage. Once that was sorted out, though, I realized, oh my gosh, that's weird. Literally 5 years to the day before the book came out, that was when I wrote the blog post, Just Keep Buying, which is arguably my first post that really kind of did well for me as a blogger, right? When I didn't really have an audience, and kind of blew up a little bit relative to my audience at the time.
12 people already.
Yeah. Went from 12 people to like 50 people. I was like, wow, this is, guys, we got a banger here.
I'm on fire.
Yeah, we got a banger here.
You've dropped a phrase there, dollar cost averaging. Break that down, because that's not something that we've really ever talked about on the podcast before.
So the issue, I have an issue with this word because there's two different definitions out there, and if you're not careful, you'll use both of them without realizing it. So the traditional definition, which Benjamin Graham, I think, came up with, was just buying over time, right? So if you have a 401k, you're making contributions every 2 weeks, every month, whatever, that's considered dollar cost averaging. You're investing as soon as you get the money. That's what it's about. There's another definition. This is a definition I do not like, and I try not to use this definition, which is, let's say you just got an inheritance of $100,000 and you slowly kind of average that into the market. So you don't put it on, you don't buy $100,000 worth of stocks now. Yeah. No, you don't lump sum. You dollar cost averaging is what they would say. I do not like that definition. I do not use that term. I don't use dollar cost averaging for that term because I think it's so confusing. You can see those are very different things. Buying as soon as you have the money, even in small increments, is very different than taking a large amount of money and slowly averaging in. Those are very different strategies. And that second strategy, the averaging in, is subpar across the board. I've tested it every way to Sunday, and it just does not outperform.
Relates to lottery winnings.
Yeah.
It's also that term is just, for most normal people, it sounds financial and it's boring.
Yeah, I agree.
For some reason, dollar cost averaging, but it is powerful. You broke this book down into two parts. The first half is on savings, and I like the way at the beginning he's like, "Look, if you have enough money saved, just go to the second part. I won't be offended." Which
the second part is investing.
Which is investing, yeah. But here's a line in here that sounds. It stuck out to me. It almost sounds harsh, but it's true, which is saving is for the poor and investing is for the rich. And you go to explain that, but I guess just talk about what that means. You know, if you're young or don't make a lot of money, investing might not be as the ticket you think it is early on. And I guess just explain that dynamic there.
Yeah, I just think that, we can just do this with a simple example. The issue is just like investing is not that impactful when you don't have that much money invested. For example, and the story I tell in the first chapter, I was 23 years old. I had $1,000 to my name. I was analyzing my investments every way possible. I was like, what should I have? 5% bonds, 10% bonds, 15%. I was neurotic basically. But at the end of the day, I only had $1,000 invested. Even if I got a 10% return on my portfolio, which is like a good year, what is that? $100? Like at the same time, I was going out with my friends in San Francisco and blowing that $100 on dinner, drinks, Uber home, whatever. Like it was very easy to blow that $100. So you can see that my investment returns didn't really matter, but my spending in a given day mattered a lot more, right? And I'm not saying that tell you not to go out with your friends or anything. That's not the point of that. The point of that story is to say, when you don't have a lot of money to invest, it doesn't really matter. What you should be focusing on is your career and how much you can save. And then once you have some money saved up and ready to invest, or you've invested it already, that's where that lever matters more. So it's about just like where you focus your attention and where you kind of get the biggest return for your use of time. And so I think when I say savings for the poor, investing for the rich, I mean that on a absolute and a relative sense. Like I wouldn't consider myself a poor person as a 22-year-old living in San Francisco. I was not poor, but I was poor relative to my future self. And that's kind of how I want you to think about it. Not like, I was in abject poverty. I'm not trying to say that at all. But just think about that. Like whether you're poor on an absolute level or on a relative level to your future self, that's how I want you to think about that problem and how you make decisions.
First of all, I just love that simplicity of that breakdown, right? Like you can't invest until you save. You can't save until you actually figure out how to make more money and actually be diligent in your savings. And there is sort of that transition between your younger self and an older self that might be able to get there, but you still have to figure out a way to start investing, right? And so I'm curious in the book, like, how do you write about turning that corner and going from somebody who might not be able to save to actually being able to like invest? Because I think there's a huge financial literacy component there where people are just intimidated, not in the market. I'm speaking very broad terms because the last year has been insane and a lot of people did get in and bought high and have witnessed the carnage. But how do you talk to people in general about that switch to becoming investors?
I think the main thing is, obviously you're right. Once you have some money to invest, like if I'd written this book in 2019, I think that question would have been a lot more would have been a lot more difficult to answer because investing wasn't as forefront as it is now. Like due to Robinhood,
it just became like everybody's armchair.
So everyone kind of knows. I think not everyone. I mean, of course, there's still people that don't. There are people who unbanked, all that stuff. But I think most people have heard of Robinhood, have heard of things. So the issue isn't with Robinhood; it's what you're buying on Robinhood, right? It's like you can buy ETFs, you can buy all the stuff that a lot of people would say is prudent investment management. So it's not the tools necessarily; it's just how you're using them. So what I would say is like, most people probably heard of Robinhood. Like, have your Robinhood account, and instead of buying things like GameStop, maybe you buy something like, I don't want to give a ticker out, but just a index fund of some sort. Broad. Yeah, okay. I did not say that.
I can say tickers.
I can't recommend tickers, but I don't. That's a great ticker. That's all I'll say. I can't recommend or deny it. But that's all I'm going to say is like there are tickers out there for broad-based index funds that you can buy that are very good and very cheap, right? And so that's an example. Eric just gave an example of one of them that you could choose from. So.
Yeah, I agree. I mean, Robinhood they are motivated to get you to trade more with the confetti dropping and it's like a casino mindset there. But you're right. You can get that stuff there. People just tend to go to Robinhood to do other things. But I like the idea of the focusing on saving and your income ability when you're young, because it's also a motivating factor. There was this sort of get rich quick, easy way with the Robinhood GameStop thing. That was a big thing. And by saying, well, look, you should really focus on your earning, you can control that early on, is a good message. Now, when it comes to retirement savings, you have this really interesting case study or experiment they did, which I love this. Listen to this. Individuals who saw the older versions of themselves, right, through an age-progressed rendering, like, when you digitally age yourself on that app, they allocated about 2% more of their pay on average to retirement versus people who didn't see such photos. Explain that. And I might use that. I might put a picture of my 70-year-old self up on my mirror. You know how Rocky had that picture of Clubber Lang up there? I might put my 70-year-old self up there just to give myself a little extra motivation. Do you have an old picture of yourself around?
No, I do not. I do not use that because there's actually other research in that chapter where I talk about. They asked a bunch of people, what motivates people to save. They found is it like a vacation? Is it your children? All this stuff. Besides emergencies, which people do want to save for. Once that's out of the way, once your emergency fund's done, the only thing that motivates people to save is themselves. Actually, so it's really like if you want to save for your future, you have to be selfish. And so I think the idea of using that Face app or whatever to see an old version of yourself is you realize you're going to be an old person. You want to take care of that old person. So that's what investing is supposed to do, right? You're supposed to be replacing your income when you can no longer or don't want to work anymore, and you replace that income through investment income, right? That's kind of the whole idea there. And so be selfish. It's okay to be selfish in that case.
Isn't that so true? Like, I read a book, I think it might have been Think and Grow Rich. Forget it was, you put something up where you see it every day. Like when I wrote my book, I had a whiteboard where I just clocked time that I spent writing, and that thing in my face every day, I'm telling you, it really, just putting something up there to motivate you, I think it's interesting. I'm not surprised that works. But I'm kind of curious to see an old version of Joel. I mean, he already looks 75.
I kind of look old. Yeah, no.
Yeah.
Whenever my brother sees me, he's like, hey, your cul-de-sacs in your forehead are looking really strong. Power alleys. So Nick, let's talk a little bit more about the investing side, because once you're in the market and you have that exposure, it's common sense just to keep buying. So what added value do you have for those of us who are active participants and are already doing what the title of your book suggests?
I mean, I think, if for some people that it's easy to do, just keep doing what you're doing. I think the issue is that's not easy for everyone, especially in a year like this where we have high inflation, there's geopolitical risk, even bonds are declining by a large amount. So even things that were considered safe are not as safe as they were. So there's a lot of things like that going on where we have asset declines, high inflation, and people are worried. So in those cases, just keep buying. It's much harder to do it. And so I know a lot of people joked oh, of course this book will come out at the end of a bull market, or I just keep buying at the top. But actually, by the time it came out, in April of this year, the market was down 10%.
Pretty good timing.
Yeah. So it's I actually wrote it more for a bear market than a bull market. And so that's my favorite chapter in the book's chapter 17, which is about how to think about buying during a market crash, which is a much different, I have a different framework for looking at that, because I think that's the only way to really kind of get through these dark times.
Well, walk us through that, because we are there. there, or so it feels like.
Yeah, well, I would say this is a more minor of a market. I mean, 20%, those happen much more regularly. I think what I'm talking about is a much worse crash. But either way, like
Which may still
the math
happen.
is the same. Yeah. So, for example, I'll give you the math in what happened in COVID-19 in March 2020. So at the time, I think at the bottom, we were down 33% going into that Monday, which was March 23rd, 2020. And so being down roughly 33%, this is just simple math. To get back to even, you have to go up 50%. And I'll just run the numbers for you. Let's say, index is at 100, goes down 33% to 66. To go from 66 back to 100, you have to go up roughly 33, which is half of 66, so a 50% gain, right? And so you just do that math. The larger the decline, the bigger the gain to get back to even. So now, once you know that, right, that's just simple math. Once you know that, you can actually kind of back out. You can say, okay, how long do I think the market's going to take to recover? You come up with a fair estimate. You can ask other people as well. And then you can back out the market's expected return from this point back to the high, right? And so at the time, I think I asked Twitter, and the median answer was 2 to 3 years. So if we're down 50%, and remember, this is not exact math, you have to do compounding, but I'm just going to make this linear. So let's say, 50%, divided by 2, that'd be about 25% a year. Divided by 3, you're looking at 17, 18% a year, like annualized returns to get back to those are great returns. Like, who wouldn't want to buy then? Like, when you look at it from that perspective, you're like, wait, this is a huge deal, right? Like, if I buy right now, you're going to give me 17% returns to get back to even, like, just to get back to even, like, that's amazing. And so, of course, there's always the case where it takes longer. But my point is, let's say you're getting those 17, 18% annualized returns to get back to even. That's a huge return. And that's why when you reframe it, you're like, wow, like, why wouldn't I be buying right now? It's clearly a bargain. And what actually happened within 6 months, you're at all-time highs, and it was like 106% annualized return or something. So absolutely absurd what happened. No one, I think, expected that. Not even as optimistic as I was. I thought it was going to take like maybe 2 years to recover, but that's kind of how I look at it. So right now, if we're down 14%, and that's not a big enough amount for me to think about, we can do the math. Okay, what is it to get back to even? Maybe 15%. Let's say it takes 2 years. You're still looking at 7% returns roughly. So that's like an average year. If you were buy right now, you're basically going to expect average returns if it takes 2 years to get back to a high. So that's not bad, right? Consider all else.
So as you're talking, and you talked about people, of course this book comes out after a bull market. Like, there's this the bears on Twitter. I could see this title kind of just pissing them off a little. Like, you just easy. The Fed was there, yada yada. Or the best one. Now do Japan. That's when everybody puts out charts of like how great stocks are over time. Like, well, now do Japan, because Japan has done nothing. Right, in your book, you pointed out since 1989, the market's been basically flat. What would you say to somebody who's like, what if we are Japan for the next 30 years?
I mean, that's, of course, is plausible. No one knows if that's going to happen or not. But I address this in that chapter, in chapter 17. I address this. I say, let's say you'd put $1 to the Japanese stock market every day starting in 1980. And yes, there are times when you're underwater, but if you look, because you're dollar cost averaging, you're buying over time, it's very different. You're saying the market's done nothing for 30 years. That's true if you put in a lump sum right at the peak. But how many people are investing like that? Maybe there's a Japanese businessman that sold his business in 88, said, I'm not worried. And then someone convinced him, okay, you should just put it all in the market. And then he puts 100% of Japanese equities in 89. Right. Okay, think about how crazy it is. Does that, and then that person's underwater. But how many investors put all of their wealth into one asset, one purchase, one time? It's very rare. So I'm saying, if you had been owning other asset classes, if you were a Japanese investor, you were diversified, all those things, that would have completely changed the conclusion. So the saying the Japanese market's done nothing for 30 years, that's using snapshot judgments, and you're really kind of cherry picking. I agree it's correct, but also at the same time, it's cherry picked. If you're buying over time, the Japanese market has not done nothing for 30 years. That hasn't been great, don't get me wrong, but it's not zero. And I think that's the takeaway here.
And I will say, this kind of reminds me, obviously I just spent 2 years in Planet Bogle, and he was not a fan of international investing, or he just said you don't need it because U.S. has enough overseas connection that you're going to get some of that anyway. And in addition, American companies seem to be really the drivers across the world, the Apples, the Microsofts, et cetera. So I guess, do you even need international? And is this just keep buying actually... Obviously, now do Japan or now do Europe isn't going to be as applicable because the companies in America tend to be really massive leaders relative to other companies in the world.
I mean, that looks true now, but I mean, so from 2010 to 2019 or 2020, however you want to look at it, the U.S. clearly outperformed international, emerging, whatever. But look at the decade before. Look at 2000, 2009. I mean, it's a very different story. Emerging crushed the U.S. So I'm not saying that's going to happen again. We don't know the future, but to only bet on American companies, I don't necessarily agree with that, because I think things can mean revert, things can change. And so while the U.S. is on top now, who knows what's going to happen? And I think the best example of this is imagine a Russian investor, at the beginning of 2022, right? They're like, oh, look, I have most of my stuff in Russia. Russia's great, all this. The market drops 80% in a month. Now, I don't think that's going to happen in the United States. We would have much bigger problems in our investment portfolios. But my point is, someone who's not diversified out of their domestic market is probably going to see some sort of pain at some point. And so I'm willing to take a little bit of underperformance now by owning international stocks. If that means in periods where the U.S. is struggling, I have a little bit more of, outperformance relative to the U.S. market. So
I'm curious, just to bring it back to sort of the here and now. What do you think changed in how you wrote the book or what you put in the book? If it was a before times book, like before the pandemic, versus what actually wrote, what changed during COVID that you brought into the book?
I actually think the best thing that helped the book for COVID was that we had the COVID crash. That was something I could just use. Hey, it's in everyone's memory. It's otherwise like to talk about 2008, like myself, I was 18 years old. I was entering college at the time. Like I didn't have a job. I didn't have to worry about income. I literally started school in 2008. So I remember like starting, going my first week of class right before classes started. And I remember like seeing the market drop and everything. And Economics 101 was really popular at the time because of that. But I think like because it was so old, it wasn't in recent memory. But because we had that crash, it really helped the book. Because I could talk about something that's really recent. Everyone investing now remembers that, right? Except unless you're like 16 and you kind of just started investing like today, like everyone remembers COVID and kind of the effects it had. So I think that's what helped the book. Outside of that, I haven't changed much. The only thing, if I could have rewritten the book or done something differently, I think I would have emphasized inflation a little bit more, because you have to realize at the time, remember all my data is through the end of 2020, inflation was low and was going lower in 2020. I'm like, I talked about inflation, I do discuss it in the book, but I didn't realize, I had no clue that, okay, by the time this thing comes out, which is going to be, a year and a half later after writing and everything, that the inflation data was going to come in where it was.
The termites were going to be all over the house.
Yeah, I had no idea that was going to happen. And so I had a lot of people like, he doesn't even discuss inflation. Like, look at the data I had coming into this. Like inflation was going lower. When I had the data, I'm like finishing this up. Like inflation was not. You
read
up
the comments.
No, of course I read the comments. You got to read the comments.
What would you be saying, or how do you respond to that group?
That's a double-edged sword.
Yeah, we can get into that.
Yeah.
But how would you respond, and what would you have put in? How would you have expanded your inflation wisdom?
I just would have included more inflation stuff. Like I've done analyses since. I've just been a lot more focused on inflation. It's just because like, at the time, like, we haven't had it really, since the 70s and 80s last time we had it, so we haven't had it in such a long time. I could talk about it, but it's like, people are like, why'd you spend so much time talking about something that doesn't really happen anymore? And it's not that I never expected inflation to happen ever again, but I address it. I just would have put more emphasis on it because people would have cared more. They would have thought that, I had thought through it more. And so that was the only thing. I just didn't know that was going to happen because people are, everything's recency bias. So if inflation's crushing everything and I'm not talking about inflation, they're going to think I'm an idiot. And I'll admit, like, yeah, I didn't try to write a ton about it. So that was kind of the only thing I could have. It's just hard to anticipate the future. I had no idea we were going to see 8% inflation. I was completely shocked by that, so.
Yeah, I think everybody was. You have a section here where you talk about in the investing part about income-producing assets. Mm-hmm. And this is clearly in the Bogle Buffett mindset. You want to invest in things that produce income, right? Mm-hmm. Makes sense. Money that works for you. Mm-hmm. The crypto crowd, obviously you don't have cryptos in here. You have stocks, bonds, investment property, REITs, farmland, and small businesses. No crypto. Mm-hmm. This is a big debate, right? Crypto doesn't produce anything. You are basically hoping somebody buys it from you for more than you paid. That's pretty much the deal. The crypto crowd, sometimes they'll go after the S&P 500 index fund. Mm-hmm. And I don't understand that. That is an interesting gap. I wonder how many young people actually understand the difference between an income-producing asset and one that doesn't like crypto, because it does seem the young crowd, the message and the narrative of crypto, it seems to be more seductive and interesting to them than the message of a boring S&P 500 index fund.
Yeah, the question is, do you want to do something fun or do you want to get rich? That's kind of the question. And like, I have like one of the most boring asset allocations out there, but it's working, right? And it's like, that's the key. Now, I'm not saying not to own any crypto. I actually own some crypto, but like I say income producing assets to be 85 to 90% of your portfolio. The other 10% is saved for things like crypto, gold, art, wine. I go through the, through the gamut of those type of assets. So I'm not saying they don't hold any place in a portfolio. I just keep them as a smaller portion of my portfolio.
That was my point. I was in a debate with somebody from that world, and I was like, you guys should just pitch yourself as a compliment to the boring vanilla.
That's what I would say.
Let us be some exciting hot sauce to your boring meal rather than your meal sucks.
Yeah, I agree. But that's not going to gain you followers to think like, oh, we're in bed with the traditional
Sounds
financiers.
so rational.
Yeah. We're in with the old world. Like, no, you want to sound like you're against that old world. There's new world, old world. It just has it's more appeal to do that. But I mean, the rational approach is like, no, there is a place for crypto. Like, I believe that people should generally get off zero. I don't think everyone should be at zero on crypto, but at the same time, I don't think you should have anything more than 5%. Even then, that's a lot because how volatile it is. That's why I have 2%, and even then, like, some people wouldn't be comfortable with that. So I'd say like just put a very, very small percentage and kind of just let's wait and see what happens with this thing.
So just keep buying. Related question: what should you not buy?
And that's a very personal question. That's like whatever you can't sleep at night with. That's it. Like, I can't. There's certain assets I won't buy. Like, I don't generally buy gold, but I don't think that I should say that no one should buy gold. I think for certain people, there's definitely cases to be made for gold. I think gold's more of a trade than a long-term hold. There's a period of 20-something years of negative real return on gold, and it's really tough to kind of hold that for me. So, I can't. It's hard for me to hold an asset for 20 years and see it go absolutely nowhere. There are exceptions to that. Maybe I could do that with equities in an emerging market or something. But for like something like gold, where there's no intrinsic cash flows, no income, it's really tough for me to believe like, oh, the story's going to flip and everything's going to be okay. I think that's why it's tougher.
This is an ETF podcast. We've gone a long time, and we have not talked about ETF specifically. What are you gonna ask him?
Sure. Yeah, I'll go there. So yeah, this is definitely sort of. I think a lot of in your book, you say I like index funds and ETFs. You basically are flat out. He just says what he does, and you don't have to do that. You can go active. I'm not. I try not to be overly rigid with this, but in the book I wrote, I write there was a little section about behavior, and I think the index fund, the idea of a cheap index fund or an ETF that tracks the broad market for 3 or 4 basis points is one of the most underrated contributors to good behavior. Because you read this book and you're like, I wonder how this would all play out if there was no such thing as a cheap index fund and all you had was like a 80 basis point blend manager versus a small cap growth manager. It's a little harder to behave sometimes, especially if that manager starts underperforming. And I think that messed people up in the 80s and 90s a little bit because their fund all of a sudden was underperforming. They panic and they just keep buying is a lot easier when you're locking into that market beta and there's a nice resignation to that. So I guess I'd like to get your thoughts on the impact that just having a near free beta exposure product has done for this concept.
I think the main takeaway here is like that, passive vehicles have benefited investors because they're cheap and because it's easy to stick with them. And more importantly, it's like the default choice now, right? Like if you talk to anyone who says, yeah, the default is like you buy a passive index fund like the S&P 500 or something. And so every deviation from that, and this kind of goes back to what we were discussing with the crypto people and why aren't they just okay with like saying, hey, we can be a compliment to you guys? Because no, it's an identity argument. And so a lot of active investors, it's an identity. I'm not a passive person. I don't want to be average, even though it puts you at the 80th percentile. We can put that aside for now. But I don't want to be average. I'm going to pick my own stocks and I'm going to set my own destiny. And there's all that kind of piece to it. I think what passive has done is saying like, here's the default option. And so when the market declines, it's not your fault. You didn't make a bad decision. That's just the market, right? It's outside of your control, right? It's like a hurricane came, financial hurricane. There's nothing you can do. But once you start deviating from, market cap passive weighted portfolios, that's when you're making active choices. And that's when you start to get in your head of like, oh man, maybe I shouldn't have only went in on tech stocks, or oh, maybe I shouldn't have, went in on these biotechs or whatever it is, or energy stocks. So that's the whole point. I think another big piece of this is identity. And so what passive has done, it has removed the identity piece from investing, which allows you to kind of not worry about it. That's why when market's down 20, even when the market was down 33%, I wasn't panicking. I really wasn't like, oh my gosh, my portfolio is like, I'm not going to be using that money for a long time. This is going to happen. It'll recover eventually. It might take a couple years, but that's the nature of the world. And we'll roll with the punches. And it recovered way more quickly than I expected, right? But that's kind of the idea is like you're going to see this stuff happen. You're going to see more crashes. We're going to see, I almost guarantee my lifetime we'll see a 10-year period where the S&P 500 is has not performed, has flat or below where it was 10 years prior.
Yeah, but I do think it is nice to have that resignation that I've got a great deal. There's no reason to switch it around because if let's say that market cap it was an active fund and it's underperforming. I think that makes you think, should I be in something else? And then you jump ship, go there. And I think there's a resignation. What am I going to do? Am I going to switch all these investments every 2 years? Screw it. And that is, I think, when we talked with Gino Martin Adams last 2 weeks ago, that she talked about capitulation, and I'm like, I don't think those investors are ever going to capitulate. The passive people are really strong. They're the strong hands. They are not the weak hands that people say. And I think one stat you have in here, which is fascinating, is the best performing 4% of companies explain the net gain for the entire U.S. stock market since 1926. So if you pick those 4%, I mean, you're loving life. But which 4%? So I think that's another one is you get your hands on everything, and you get those. At least you lock in those 4%. You don't get all of it though. This is why I'm bearish ESG a little bit, because on the 4% includes ExxonMobil, Apple, Microsoft, General Electric, IBM, etc. ESG, what do you think of this? Like, you wouldn't get Exxon. You'd probably, and Tesla is now not in the S&P 500 ESG. Is that, in your eyes, just another active management in disguise? Or do you really think this is a better way to invest in your just keep buying premise?
I mean, I think so. I think what the industry is going to eventually move toward is something like, a direct indexing, or something we call custom indexing, where you get to pick and choose kind of based on your personal beliefs. And so I understand why people would do that. At the end of the day, the counter argument is, okay, well, if you're doing these ESG type moves, what if all the companies you don't buy end up outperforming because no one else is buying them? So in theory, you're under allocating capital for some reason relative to the market portfolio. So someone else is going to over allocate and they're going to outperform you. And so the question is, do you want to take that money and grow it to as much as possible and then donate to causes you care about, or do you want to just not invest in the underlying companies? And those are the two ways you can do it. And I think they're both valid. And it's a question of, some people are like, I don't want to give my money to a gun manufacturer. It's like, it's not technically going to them, but in theory, they could buy back stock, they can sell stock. And so the equity could be used for that purpose. So yeah, I don't have a great answer there, but I think we're going to see this area evolve as like kind of custom indexing comes in, where people are going to be able to allow their choices to be dictated in their portfolio.
So I will say custom indexing, I'm bearish on it. I'll just get on the record. I think anything trying to dislodge a 3 basis point index fund it's a very tall hill to climb. I think for very wealthy individuals it might work, or hardcore hippie ESG types. But that's not ESG investing, because a lot of these companies that you would think in your perception are not good, like Exxon, they actually score pretty well on ESG scores. People's perception is not really the same as an ESG scoring system. But I agree with you. At least it's custom to your liking. I just think in 10 years, if that custom portfolio underperforms, you're going to have a seller's buyer's remorse. Plus, I just think dislodging 3 basis point beta is just, people love that stuff, man. I mean, it's like such a good deal. So, but anyway, I debated this with Josh and Michael Batnick on an episode of The Compound and Friends. If anyone wants to listen to, we had a nice, long, lengthy debate on direct indexing. We got to get we have to do an episode on that soon, Joel. That's going to be a good one.
Add it to the list. Okay, so earlier you said you can't recommend a ticker, but that doesn't mean that we can't ask you for your favorite ETF ticker, which is a question that we always ask at the end.
I guess, okay, if I have to, my favorite is VOO, the VOO, of course. My dad has this funny thing. He says, I'm hedging my VOO exposure with SPY. And I'm like, I couldn't handle, I was like, what is like, I didn't know that was possible. I know it's just a joke.
Wait a second, my head hurts.
He says, I'm hedging my VOO exposure with SPY, right? It's like,
that's basically like issuer hedging.
Goes out of business? No, it was a joke more than anything. Yeah. He's like, I just hedged my VOO with SPY.
Yeah. Like you're all in.
Yeah, you're all exactly. Just keep buying. That's what I would say too. Yeah, of course. Yeah, he's on the just keep buying train too.
Does he do that because of you, or did you get that from him?
No, he does it because I obviously wrote about it and stuff. But he like edits my blog, so every week he reads every post that goes out. Yeah, my blog.
That's cool.
He didn't edit the book. We actually got a professional editor, but he's edited a lot of the posts and all the material that went in there. Roughly half of it's old material, half's new, I would say. So
I got to say, I felt like when I read this, I was sitting with Ritholtz advisors and almost like getting some of the secret sauce on how you talk to clients. Is that fair?
I mean, a lot of the ideas that, I have and they have are very similar, already aligned already. That's why it works so well. I didn't have to come in and like rethink everything, like, I don't agree with this. And I'm saying we're not 100% aligned on everything, but a lot of the core ideas are there. And like we would agree on a lot of the stuff there. Does that mean we agree on everything? No. There are certain things where we may not agree perfectly on. And I've gone back and forth on some of these things, whether that means stuff like trend following, whether it's how we allocate to crypto, all sorts of stuff like that, where I don't think our firm is doing anything incorrect or bad or anything like that, but where we may may not be in 100% agreement. That's fine. Like, not everyone agrees. Like, for example, I have a whole chapter on don't buy individual stocks, right? And I know there are people in my at my firm that own individual stocks. It's not the bulk of their money. It's a small percentage, but still, it's like something that I generally don't do. And once again, that's kind of how I think about it. Is like, let's think about the overall picture, and do we agree on the core tenets? And we do. And then, so that's where, if you feel like that's because we generally agree on a lot of their core.
But like, if someone
tenets.
goes to Ritholtz and they're sitting down, you kind of go over like, well, let's save first. Let's look at that. You got to go over that kind of stuff.
Well, it depends where they are, right? If you're 75 years old and retired, savings is not going to matter. It's, you have a huge nest egg. Let's figure out how to protect that. So it's, once again, the ideas here can be applied generally, but yes, I kind of agree with what you're saying. So,
Nick Maggiulli, thanks for joining us on Trillions.
Appreciate it, Joel. Appreciate it, Eric. Thanks.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, and wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Francesca Levy is the head of Bloomberg Podcasts. Bye.